Welcome back, everyone, to Vox Live. My name is Paul Hill. I'm delighted again to be able to speak to legendary small and mid-cap UK fund manager Gervais Williams of Premier Miton. So welcome, Gervais.
Good morning, Paul.
Yeah, we've had a lot of news of late, not least, actually, Saturday's assassination attempt of President Donald Trump, or sorry, not President, but ex-President Donald Trump, and obviously England's defeat last night, which is a bit unfortunate, to Spain 2-1 in the Euros. But we thought we sort of run through your outlook for the markets ahead for the rest of the year. I don't suppose you could quickly remind the audience of what type of investor you are, what kind of stocks you like.
Yeah, the bottom line is, we're here to make serious money for our clients. And in that regard, clearly, one of the advantages of small companies is they have more upside potential. And we really want that to be an evergreen potential. And, even when markets are more unsettled. So companies which generate not just cash, but lots of surplus cash, over coming years are those which we really select for. Companies which are often investing hard now, which are then, conclude an investment period, get the payback on the previous investment, and then see the cash generation. And if you get those right, as I say, you can make some good money for your clients, irrespective of whether the markets are actually buoyant or not.
Yeah, we've got plenty of stocks with lots of surplus cash in your picks. If anybody wants to ask Gervais a question, obviously just drop them into the chat bot and I'll read them out. Now, Gervais, in terms of the sort of like the second half and also the sort of your first half performance, how are things progressing and how do you see the sort of the road ahead?
Yeah, to be fair, we have seen some slight pickup in small caps. Really, the feature of the last 12 months really has been that mega caps have continued to dominate. And although, particularly last week, there was a big sort of reversal of mega caps underperformed, small caps started to pick up in the US. We really haven't seen that wave of interest really move down the market cap range, in a convincing way. It's happened here and there. There's some nice patchy outperformance of some small caps, but we haven't really seen that long-term small cap effect very much for the last 7 years. So it's overdue. It's going to come. I'm sure it's going to come. I think it's very due very shortly now. But most particularly, until it does come, people don't always appreciate the scale of the upsides.
Yeah, and have the redemptions sort of like ceased now in the UK in small caps? Because I did see Premier Miton actually, your firm put out a trading update and mentioned that actually in June it had seen positive inflows with that the first time for quite a period.
Yeah, it's still quite patchy, as you'd expect, near the bottom of the market. Some days there's outflows, some days there inflows. So it's not as though it's completely stopped. I would say I've been surprised really that the outflows, particularly out of UK OICs, have continued even as the UK has broken out on the upside. It's been in a fairly dull trading range since 1999. It's only the last year or so when it's broken up, particularly in the last 3 months on the upside. And I thought that would have slowed local sales. It has to some degree, but it hasn't stopped them entirely. So still some patchy days. But as I say, even slight changes now can make a very big difference in share prices.
Yeah, and I guess also that rotation from large cap, also mega cap to small cap. There must be at some point a destruction of capital allocation in AI, because that's really been driving the top of the market. And there's so much money being put in chasing the same gains. Eventually, that is going to be effectively, negative ROI, I guess.
Yeah, I sometimes talk of the sort of dot-com boom as being the fire practice. I'm not saying this is the sort of going to be a roaring fire, but it's not going to be a fire practice. The valuations of some of these very large companies in the US, particularly, but just other mega caps around the world, are so large now that if they do start to fade, if they do get caught out, the downside is quite considerable. So specifically, I think there's a real danger that markets actually stop going up, because you get so many setbacks in some of the larger companies, and that actually market beta, a lot of index funds are bought because they've got a good market beta. I think market beta could become worthless for a number of years in the future. So I think there's a massive change to come through. I think it's going to be pretty tough. I think real growth will be quite patchy. I think market liquidity may get a bit tighter. But actually, quoted companies can acquire assets from the receiver, often for £1, and make disproportionate return. Retain that employment, retain that investment, get the full payback is pretty exciting. And so I think not just the UK market, but particularly small caps in particular, small caps in the UK specifically, are really well positioned for the future at the moment.
Yeah, and I think active fund managers additionally as well, because you're probably going the indexes are going to get a bit of a drag from the top of the market. Whereas actually, if you're a good stock picker, okay, let's move on to one of your stocks, which has got shed loads of cash. Actually, it's U Group, which is a B2B sort of utility in the UK. It does sort of all the sort of electricity, gas, and other sort of utilities, and it's really been a rocket ship with the share price. And I guess the sort of question is, do you carry on sort of running the winners, because it seems to be sort of like not putting a foot wrong here?
Yeah, I mean, what's interesting about U Group, I mean, it has been, as you say, it's been a terrific performer. Share price has gone up around about 9 or 10 times,
Yeah.
actually, sort of in the last 3-5 years. But most particularly, it's actually grown incredibly well. And the big disappointment for us actually is the valuation is still subnormal. So this is a company which is, its sales back in 2020 were 100 million. 460 for the year just finished last year, but most particularly according to the analysts, something like 670, 750, 890 over the next 3 years. I mean, this company's grown enormously. It's generating very large amounts of cash. Specifically, it doesn't need much of that cash in the way it did before, because it's done a collateral deal where Shell provides all the different energy supplies, and they don't need to provide collateral. So the growth rate is now less restricted. It's probably got 110 million of cash left at the end of this year. Free cash flow yield of 14%. So there's a rocket ship, as you say. It's done incredibly well up to now. And the disappointment, like most of the small caps we have in our portfolio, is that the valuation is still really quite understating the upside potential.
Yeah, 9 times PE, and it pays a sort of 2.5% dividend yield.
Absolutely. I mean, the market cap's about 280. So as I say, if it has 100 million or 110 million of cash at the year end, then clearly, that's also, if you netted that off the market cap, the valuation is even lower. Of course, the free cash flow yield on that basis is even higher. Extraordinary. I mean, it's a wonderful company, of course. We're very excited about it. Unusually for us, we do take profits on the way up, but it's one of our largest holdings at the moment. Not because we just run our winners. We like running our winners, but most particularly, we haven't got many other companies which are utility-like in terms of their returns. And specifically, if we are going into a global slowdown, if things get tougher going forward, then utilities are due a period of outperformance as well.
Yeah. Okay, look, we've got another one in that sort of energy sector, but this is an oil and gas sort of like exploration and production business called Zephyr Energy. Very interesting. We hardly ever cover this, actually. And I think it's sort of like exploring and producing energy or oil and gas in the Rockies in the States. What sort of attracts you to this one? Obviously, it's got a big deposit out there.
Yeah, I mean, the nature of it is, I mean, onshore oil and gas is much easier to find. You can absolutely get away with, smaller oil fields and such like, and making a commercial return. Actually, just a bit like, U Group specifically, over the last 4 years, yes, this one's up about 9 times. It was 0.55p. It's now about 4.8p. But most particularly, look at its potential. I mean, it's drilling obviously well in the Paradox Basin at the moment. That's Utah. Onshore, as I say. We're waiting for data on the pressure of the reservoir, the fluid percentages, how much water is involved, permeability of the rock formations. But there's another 30 wells potentially like this. And the question is it a fairway? I think there's a risk it is a fairway. And the analysts, this is unrisked. Don't get too excited, because unrisked doesn't mean we're going to get this. But if it is a fairway, they think it could add another 1.9 billion to the asset value. The 106 pence on top of the upside, of 4.8. And I think there are people out there with price targets of 10 and 12 and all that kind of thing. Again, this is just on the moment of generating return on heavy investment in the past, generating surplus cash. As you know, we're very keen on that, and that's really been a feature of this kind of company. And don't get me wrong, I think we do need to worry about carbon intensity and all the rest of it. But I think even in 2050, we still need some crude oil to actually produce all the plastics we use in our hospitals and other places. So it's not as though we have to completely move out of this industry entirely. We think we want to operate with responsible operators, but most particularly very efficient operators such as Zephyr.
Yeah, and is there the in the Rockies? I mean, it's quite mountainous. Is the infrastructure in place to be able to actually transport this? I'm guessing there's no pipeline, so it probably has to get out using trucks, I guess, and maybe
No,
trains. I
no,
don't know.
actually, interesting enough. I mean, actually, they've got a pipeline very close, so they can cook up to that. It'll cost, some money,
Yeah.
but small amounts of money. No, they've got one of the largest, sort of trans-American pipelines, very, very close, gas, of course, and they can just get into all that. That would be a very easy thing. Again, not a problem. And actually, their acreage happens to be a relatively flat area in the Rockies. It's not a sort of the bit which you see on the Cowboys films.
Yeah, up in Colorado.
Absolutely,
Yeah, I
this is
know.
Utah. Yeah, yeah.
Exactly. Okay, another one with plenty of cash and has done very well for you is Supreme, which is the FMCG sort of affordable products business in the UK. It's sort of like done mainly vaping products, but it's branched out into sports nutrition, into batteries, lighting, and recently bought a soft drinks business, Clearly Drinks, out in Sunderland. I mean, the shares have done extremely well. What's your latest view on this one? Because it's obviously gone up from about low of about 70p to about 180 now.
That's right. I mean, again, look at it a year ago or whatever, the share price was extremely low. To be fair, the batteries business was slower for a period. Its lighting the previous year had a few problems. But the bottom line is it is dominated really by the vaping and the branded, does Elf Bar and Lost Mary and that kind of thing. So it's got a very core business there. That's becoming increasingly regulated. That's a good thing. This company is a very responsible operator. Further regulation gives them extra market share. But most particularly, they've made a series of acquisitions where they've really generated quite attractive amounts of surplus cash as a result of that. And so what you've seen is the share price has moved up. Already this year we've got up to 140, as you mentioned. It had already risen, but now they've bought this Northumbria spring water business. So this is obviously in supermarkets, soft drinks. They feel that they can improve the efficiencies. They feel they can massively make a difference to ultimately the sales. It's only doing about 22 million of sales. They paid 15 million for it, but they believe they can make a really nice cash surplus on that. So as I say, the share price has gone up quite nicely. It's still only on about 9.5 times for March 25, 8.8 times thereafter. I think Sandy Chadha, it runs the business extremely well. I think FD is extremely good as well, by the way. But I mean, it's probably it's not always an industry which everyone thinks, oh, this is a good place to make money. Not so much just the vaping, but all the lighting and the batteries. But they supply a lot of corner shops, and they are very efficient in doing so. And as a result of that, they make plenty of surplus cash. And that's really the finishing post for us. If we can get a range of different risks where they generate plenty of surplus cash, then hopefully you generate some pretty attractive returns over time.
Yeah, no, I would agree. Okay, good. Let's move on to we've got Buildtech software business. We've got Eleco, which basically has been around for quite some time, but it helps the digitization process of sort of project management for building infrastructure and sort of large offices and properties and stuff like that, and also does sort of like visualization. It's had a transition over the last 2 or 3 years from perpetual license to SaaS, and it's come to the end of that largely round about. It's got 75% now SaaS. And again, the shares now have started to move. It's been pretty much undervalued, and it seems to have reached a tipping point. I don't know what your latest views on this one, because it's a pretty unique asset actually on the UK software market. I don't think anything else does this type of technology.
No, I mean, it's market leader. What we really like is companies which aren't just investing, aren't just generating, obviously some returns, but most particularly are leaders in their industry. And the Asta, the project management software they have, has won, best in class for 10 years in a row. So that's pretty impressive. More recently, they've really scaled up the market position because they bought Best Outcome. They bought a small business called Vertical Digital as well. So it's not just that they've got the SaaS, the annual recurring revenues of 25 million or so, but most particularly now the opportunities to sell across a wider range of customers. Again, we're pretty excited by that. We think that will generate a lot of cash. When you do get lucky in software businesses, because the capex in terms of developing a software is not in the same way, you can scale that across a larger number of customers. You can get very lucky in terms of not just growth, but also cash generation, as I say, the cornerstone of what we think. Specifically, I would really like to emphasize as well that I think the leaders in this business, Jonathan Hunter and his team, effectively, I think he really looks after the business really well. I think it's a very motivated team of software consultants. I think they sell extremely well. I think customer outcomes extremely good. That's why they win best in class in management software, project management software every year. So, but those are the kind of combinations we really look for, and what a strong business this is, and how overlooked it was a year ago, and actually even now we still think could scale up considerably more than people think.
Yeah, I would agree. I think Cavendish have got a 160 price target, and it's got sort of the secular growth drivers of increasing infrastructure, build around the world, and I think it's now got a bridgehead into the US as well. So yeah,
absolutely, the best outcome acquisition, I think, is really quite exciting for them.
Yeah. Okay, good. Well, let's switch sector. We've got medical devices now. I think you've probably got in at the right time, but I've been a suffering shareholder for some time. It's Inspiration Healthcare. It does neonatal baby warmers and ventilators. It was actually a bit of a darling during the lockdowns because it built ventilators for sort of adults. Anyway, to cut a long short, it had a bit of a tough 2023. We had sort of like industry destocking, some contract delays, plus I think there's some regulatory delays, and they were forced to do a placing at 14p just recently, which hasn't got through. I think it needs a general meeting approval.
That's right. Yeah, we haven't paid for that yet.
Yeah, but what's your sort of your latest on this one? Because the CEO has obviously decided to step aside, and there's a bit of a very experienced exec chairman, Roy Davis, now in charge, sort of steering the ship.
Yeah, I mean, it's kind of had a toughish time, partly because obviously, as you say, incubated demand fell off in the adult side, but the neonatal incubators, they've got new technologies. They've made a major acquisition 2 or 3 years ago, which allowed them to really scale up their global market position. But most particularly, they also took the advantage of that moment to actually build a manufacturing and tech center. That's quite a lot, cost quite a lot of money. And then on top of that, a very major order for the Middle East. They actually built the products, but unfortunately the customer's unable to pay, and still hasn't been delivered actually. So a combination of a lot of working capital plus the manufacturing center plus sales under a bit of pressure anyway has meant the share price has actually come down an awfully long. Look at it here, it was 140 back in 21. So it's below 30p, as you say, with the placing now. Yes, I mean, we've become more interested in this recently. We've been actually buying it at the lower levels, and we've absolutely cornerstoned the placing. We think it's a great time to get involved. So that takes some of the balance sheet issues away. Market cap is still tiny. I mean, there it is, 12 million plus the 3 million they've just raised. It has been 130 million in the past. I mean, I'm not saying it's going to go up, that much, but it's a very strong business. It's got a very, very strong technical base. We think that some of those kind of one-off issues, like the delayed order, like the manufacturing center not getting enough volume through, can be resolved. And as that happens, as I say, it doesn't just generate cash. It then generates potentially a very large amount of surplus cash, and that's really what's going to drive the share price in our view.
Yeah, and any views on the sort of the new team, Roy Davis, because he's got a great reputation at Optos, and I think he was the chairman of Medica, which obviously got sold as well.
That's right. I mean, obviously, it's in a way it's sad to see Neil, the founder, leave, but he's still on the board. But most particularly, I think this is a business which has, it's like a sleeping beauty, and I think with a little bit of care and perhaps a sort of warming up of the sales, I think there needs to be a more kind of sort of closer, tighter sales process. I think they could sell an awful lot of products. So I think Roy's going to do a very good job on this. Hence, we've supported the issue.
Good. Okay. Well, let's obviously work in progress, but plenty of upside. I have noticed actually they've got a trade buyer who's bought some about 6%, I think, Menon Medical, which is they do sort of like wanting to get into this area. So all interesting stuff. Okay, let's on the same theme of infrastructure. We've got Galliford Try, which is obviously a big contractor in the UK, got a good reputation, and it's turned its business round significantly. I know we've chatted about this before, but considering it still performs very well. I think it came up with the trading update only, was it last week, with above expectations. Do you want to give us your latest view on this one? Because thin margins, but it generates cash, and he's hoping to actually lift those margins as well, I think.
That's right. I mean, the key about these businesses is that they grow a little bit every year, and then they have a big write-off because their contract gets caught out, and that's been the nature of many of these businesses. And what we really like about Galliford, and we've liked it 2 year as well as recently, is that Bill Hocking has brought in this very sort of sophisticated way of making sure that the kind of contracts he goes for don't have open-ended risks. Some of the contracts which other contractors go for have these open-ended risks, and they end up in dispute, and people lose money and all that rest of it. So this is a company which I think has been very focused on its right kind of customers, has an extraordinary balance sheet. I mean, given that the share price has already doubled over the last couple of years, there's still got 227 million of cash, no debt. It's got PPP assets of 42 million as well, so 270 million. And the market cap, even after the recent spike up, with the recent trading statement, is still only 318 million market cap. It's kind of tiny. So, this is a tiny market cap for a very big business. It does an order book of 3.8 billion. Now, that's not all in 1 year, obviously, but that gives you real visibility in an unsettled world. So, one, we think that actually it's very unlikely to get some of these problem contracts. Two, it's already, even though share price has gone up, still standing on what we consider to be a very overlooked valuation. It has paid a special dividend. It had a contract settlement from previous to Bill Hocking's period, which allowed them to pay a special dividend. They've made a couple of good, really excellent acquisitions, North Midland Construction, one or two others, with massive cash paybacks. There's lots of investment to go in, particularly in the water sector, where they're strong. So, we continue to be pretty excited about this one going forward.
Yeah, it should be a beneficiary, I guess, of the new Labour government. If they release some sort of get some private investment into infrastructure and get that ball rolling, then they're one of the key beneficiaries, I would have thought.
Absolutely. No, I think there is going to be quite a lot of stepping up in investment spend going forward, and that's good. We need more investment in the UK.
Okay, good. Okay, well, in the same sort of area, we've got Lord's GroupTrading, which is a builder's merchant, and it does plumbing and heating products. We've had, unfortunately, as we all know, a bit of a wet spring and an even wetter summer so far, which hasn't helped construction. And then on top, we've had the disruption of the general election, which has been a bit of a pause on the sort of construction activity. I think the whole of the building products area has suffered a bit, has been a bit downbeat. But obviously, investing is all about the future. So what's your latest on Lord's GroupTrading, because it's had a good reputation in the past?
Yeah, I mean, I think, again, what we really look for is companies which are, very good at motivating the staff so they can deliver good outcomes. I think this is a characteristic of Lord's GroupTrading. Specifically, as you say, it's actually struggled a bit since issue. It did come at market at 95p, now only 42p. That's partly because I think they had a slower period. They had a big problem with their plumbing and heating business, where a lot of suppliers, they weren't able to get the supplies in because of disruptions during COVID, and that led to a major sell-off. We've now had the slowdown in RMI activity, and specifically, with interest rates remaining higher for longer, of course, housing activity hasn't picked up as much as might have been expected. So there's been a kind of series of disappointments from that point of view. But as I say, focus on customer service. Market cap now is only 70 million. It's quite a big business under the bonnet, say 450 million of sales. And if they can just generate some cash from here, then we think that actually that will lead it to not just, obviously improving in profitability, but most particularly, I think that'll drive the share price pretty hard, actually.
Yeah, and if you believe that the housing sector is actually improving, if Labour does get anywhere near its targets on building even affordable homes and stuff,
absolutely,
then that should
there's going to be a lot of merchanting required, and the plumbing and heating business will obviously improve considerably as well. It's already picked up, but I think there's much more for it to go.
Yeah. There's always a lag, isn't there? Because if you build new properties, then by the time you need to put in the foundations first, then the walls, the bricks, and then you put in everything else, the building products afterwards. So there's always a bit of a lag. Yeah. Okay, good. We've got another absolute rocket ship, which I think has tripled over this last year, is CMC Markets, which was certainly last year it was a traditional spread better CFD provider, but really has now moved into B2B and into technology, and it's gone into institutional rather than consumer side, and it's really metamorphosized into more of a fintech supplier now, and the shares have done really well. So what is your latest on this one? Because I've missed it. I wish I'd got in earlier.
So, I mean, I think we should go back to the core business, which is this large execution business, which I think is very impressive. A huge number of APIs plugged in across the institutional market and a wide range of customers. And that still remains very much this core business. And what we like about that is when you do get very unsettled markets, as we saw in 2020 going into 2021, then that business itself can generate a very large amount of cash. So in the past, going back to April 21, this share price was 5.30, right? It had risen from 78p up to 5.30 over the previous couple of years, but even so, that's the scale of it. It's currently now about £3.13. But coming back to it, I mean, what they did, over the last couple of years, one, as they didn't have the same volumes, so the volumes came down, so turnover fell, profitability was lower. But more important than that, they actually have made major upgrades in terms of their software to improve direct-to-consumer functionality. Now, they already had a direct-to-consumer business in Australia. The opportunity is now to roll them out across a wider range of European customers. They've announced Revolut as their customer.
Yeah.
I think that's going to be quite exciting. But I think there's more behind it, actually. I don't know when or what companies there will be, but there's opportunities for them to offer their services to other major brands, which can then use it. So I think that's one. I think the underlying business, the investment has peaked out. So therefore, the profitability is improved. Secondly, there has been some volatility, so they've been able to pick up more volume. So that's driven the top line. But most particularly, even now, I mean, here it is, at 313p, having peaked at 530 in the last cycle, and I think being a better business now than it was previously. So again, if you get things right, you could be surprised by how far the share price can move.
Yeah, I would agree. I think certainly I hadn't really appreciated how much sort of like institutional business runs off their rails, because they've built this technology platform with cash equities, with options, with commodities, with crypto, that they just plug into people like sort of Revolut. And I was looking at their slide pack actually, and they've 40% of their trading volume, which is their biggest division, is institutional, which means it's third party. So they just clip their activity, which it's a great business model, recurring revenue streams.
Absolutely. And as I say, if you do get unsettled markets, this is a kind of company where you get more volume, because when bond yields suddenly move or awful lot or whatever, then they can do more of that. So coming back to it, I think it's it's just less correlated with the rest of the portfolio, and we love that. As I say, particularly in the tough years, it can make out like a bandit sometimes.
Yeah. Just to remind everybody, if you want to ask any questions, please drop them into the chat. But I guess people are probably suffering a bit with hangovers from the football last night. But
the Spanish won the Wimbledon as well, so they had a very good day yesterday.
Yeah, they did. Yeah, they've been definitely celebrating. You've probably got a Spanish audience here. Okay, let's move on to microchip technology. We've got CML Microsystems, which does sort of like I think it's rugged sort of chip designs and stuff for industrial applications, defense, aerospace, automotive, but also probably into sort of all kinds of different activities there. It's got great technology. It's difficult to actually see how, because I think there's been some destocking to see the growth. What's sort of your latest on this one? Because it should be a matter of when, not if.
Yeah, I mean, to a casual observer, there is 50 million market caps, quite small. A lot of institutions wouldn't even bother to look at it. Secondly, of course, it's a business which hasn't grown an awful lot recently. Don't get me wrong; it's it's in with the national security of the US government and all that kind of stuff.
Yeah.
So that's all fine. But I think, again, people just overlook the sheer strength of the business in terms of cash and cash generation. So at the moment, it's just bought back 1.75 million quid's worth of shares, but most particularly, it's still got 18.2 million of shares against a 51 million market cap. And this is all public information, it's got 15 acres of land to be sold from its Oval Park current state at the moment, and its Fairham operations in hand. So again, it's going to bring in some millions. I don't know how many millions, but some millions on the back of that as well. So again, here's a business which is actually a very nice strong market position in its current business. We think it could get lucky once the kind of overhang of components runs out and we get a pickup in component demand and etc. We could see this thing spike up on the back of that. But most particularly, it's coming to that upside with potentially a very, very strong balance sheet, absurdly strong balance sheet. And so when it does come right, not only does it come right, but also, of course, it's the ability to actually make further acquisitions or buy back shares or whatever they're going to do, pay big dividends. We don't really mind, whatever it does. That's the kind of rocket fuel which then drives the rocket ship later on. If it does, it may not be a rocket ship, but some of them do turn into rocket ships, and that's the opportunity, really.
Yeah, a lot of people have been talking about in similar sort of ilk as Filtronic, that if it finds an application that is suddenly becomes the number one player, like low orbit sort of like satellites, then this technology would just absolutely do brilliantly.
Yeah, brilliant. No, again, it's really that's really this. There's quite a lot of companies like this, and as I say, if you've got the downside protected with a large balance sheet, then don't get me wrong, the share price can go down, but obviously the upside, as you know, with a lot of these small caps, is it can be it's very substantial. It's not just 30 or 50%. It can be that much, but it can be a lot more than that. And that's the opportunity, that risk reward ratio, almost option like, and with small caps being so out of fashion, with the UK being out of fashion, with micro caps being particularly out of fashion in the UK, the bottom line is that they have the risk reward ratio is much more favourable than I've seen in previous years.
Yeah, another one which is in the similar sort of area in sort of industrial tech, etc., which has found its niche is Cyan Connode, and it does sort of like RF, sort of like communications, hardware and software. It's really sort of grown very well out in India, putting the sort of mesh networks in. I know you talked about it very positively. The shares still haven't moved, and I guess that's probably just a reflection of small cap markets not recognizing it. And what's sort of your latest on this business?
Well, I mean, the RF mesh network is particularly applicable to smart meters. They've spent 10 years building their Indian market position. They believe they're the market leader in terms of the supplier into smart meters in India. Clearly, what they're doing now is the Indians are going for 100% smart meter network, a bit like the UK. Although in many cases, a lot of the Indians don't have direct meters at all. They're just part of a group. So this will be much more sophisticated. And they've got actually an enormous number of tenders out there. But we've been waiting. And one of the reasons share price has been depressed really the last 6 months is that we've been waiting for the Indian utilities to make decisions about which units they're going to use and which smart meters, and so that's just not happened. And obviously it's a bit disappointing. I don't think it's because other people have taken orders and they haven't. I just think no orders have been placed, and that's been quite frustrating. And people, been excited by the story perhaps 6 months ago, kind of saying, well, it's just not happened. They've gone off through other things. So I think it's very overlooked at the moment. They kept up, they kept going. They've got some orders from Africa, some from the Middle East. The latest trading statement in April actually was slightly above expectations in terms of sales. So companies doing perfectly well. This isn't driven by disappointment in terms of sales, but obviously what hasn't happened is we haven't seen these major contracts. And when they come, they could be very substantial. This is a company which is 24 million market cap. In terms of the total orders out there, which they've been asked to tender for, and clearly they're not going to get all of those. We're talking about hundreds and hundreds and hundreds of millions. So even if they only win 10%, obviously I'd like them to win a lot more than that. But if they only win 10%, this company could then generate substantial cash. But of course, between now and then, nobody knows. It's very frustrating, as it is for many of these companies in terms of the management teams, because the share prices are so depressed. They wonder if anyone's ever going to turn up looking for these kind of companies. And so, the nature of markets, of course, is when they get stuffed more than you expect. Clearly, when they recover, they can recover more than you expect. I think that's going to be a feature of the UK market, but specifically smaller micro caps in the UK.
Yeah, I also suspect this the sort of the air pocket in orders has probably been a reflection of the Indian elections. Actually, it's probably done.
I assume that was one of the reasons, but obviously the election has now been resolved, and we still haven't quite seen any contracts as yet. But maybe they're coming out, in weeks or months from. Yeah,
well, they've had to sort out a coalition, haven't they, with Modi or whatever?
Well, maybe that's held them up. Perhaps that's part of it. Yeah.
Just as a sort of like when you invest in overseas companies, particularly frontier markets. I wouldn't say India's frontier; it's a sort of major market. How easy is it to sort of like, if they're successful locally, to get money out from those companies to pay dividends to shareholders in UK? Is it relatively straightforward, or?
Well,
with holding tax?
In the past, it has been. I mean, it's been. I think that's a very good question, Paul, because I think actually, the last 30 years, particularly, have been globalization, and globalization has been defined really by a very large number of hard currency surpluses all around the world, meaning that anyone who wanted hard currency largely had it. And so you did get some companies which ran out of hard currency, Argentina, Turkey, some special cases, but most of the countries actually have had a relatively easy time of it. We have made a major change to our portfolios over the last 3 years, where we believe that actually hard currency is going to become much harder to get. After we move beyond globalization, in this period of more unsettled sort of global tensions. So we think actually hard currency is going to get tough. We think quite a lot of major countries will struggle a bit. Some countries, even some, quite well-known Western countries might struggle a bit going forward. So specifically, we have really held back on that. So going back to India, we don't mind investing in India, but we just don't want too much in India, because we think if India does get to a position where they do struggle to generate hard currency, where you can't get the cash out, then that's going to make a massive difference to the valuations of the companies within there. So we've pulled back from many of the emerging markets, perhaps some of the less well developed markets, just specifically on currency fears, actually, the ability to get hard currency. Even the UK, I don't think is entirely, it had its own currency crisis in 1976. I know it's probably well before you were born, but specifically,
I remember it
when actually the UK ran out of cash. It literally ran out of cash.
Yeah.
We had to go to the IMF and borrow 4 billion in 1976. So not an easy thing, very tough. I think it's going to get a lot tougher for all sorts of companies, but I think companies with strong balance sheets, companies which are looking after their customers, motivating their staff well, unfortunately, I think quite a lot of the zombies will fall over. I think quite a few of the private businesses which are overgeared will fall over. I think there will be opportunities to acquire those from the receiver for £1 and make good returns. And that's one of the reasons why I think actually that small companies will actually outperform big companies, not just because they're nimble, but specifically they're able to actually move faster than many of the big companies. And the uplift in terms of the acquisitions is much more significant when you start off as a small cap than when you add an acquisition upside to a large cap.
Yeah, no, it's sort of quite topical at the moment because PZ Cousins had a real problem. It's got a business out in Nigeria with one of its subsidiaries, and it hasn't been able to get money out efficiently from Nigeria for years. So it held a big Nigerian local currency exposure, and that sort of netted off on its cash. Unfortunately, when there was a huge devaluation of the naira, it meant that its perceived value in sterling decreased by about 80%. So it lost all its cash, and therefore its net debt ballooned out. But sort of a bit more.
Well, that's such a good example of the kind of nature of risk. It's not just that you've got a lot of naira in that case, but actually, if you want to turn it into hard currency, it's not as easy to sell a naira and turn it into hard currency. And you can't pay your dividends in naira. So from that point of view, it really makes a big difference to the returns for investors. And as you know, the PZ Cousins share price has been quite weak as a result of that.
Yeah. Well, I think the hangovers are shifting. We've got a question from coming in from Steve Lewis. He's wondering if you've ever had a look at Invinity Energy Systems. I think it's basically a sort of battery technology company that doesn't use lithium. I think it used something else, which I can't remember what it is. But I don't know if you ever had a look at this one.
Yeah, no, we've been watching it for many years. It's actually vanadium. It's called an vanadium flow battery. And the reason why I bring it up is actually because, you brought it up, and why we're interested is because actually vanadium flow batteries, they don't decay like lithium batteries. So as you know, if you have a lithium car battery, over time, it gradually degrades. It doesn't charge up as much. It discharges quicker. There's not so much energy in it. And eventually you have to replace the battery and you have to kind of break it up and try and recycle it, which is quite difficult at the moment. With vanadium flow batteries, you have to change the pumps and things, but 10 years, 20 years after it's been built, you will still have the same amount of energy which can be stored in these vanadium flow batteries. So the first thing is that they are more long lasting. The second feature about them is they're very good if you can get them down to unit costs, where you can link them up with perhaps things like solar farms. Lots of spare energy during the day. Obviously, we want to use often some of that energy during the night. So if you have a battery farm alongside a solar farm, then effectively you can actually have 24-hour supply. Yeah. So then you can then begin to replace perhaps some of the things like some of the gas power stations. So what's interesting about Invinity, and we are actually supportive of the companies, we were very supportive of the last fundraising, was actually that this company raised 50 million. It was only 50 million market cap. Share price has come down over the last few years. But we think that it's actually now going to be quite competitive with gas in certain applications. And as that starts to come through, then obviously, this will actually lead to a major investment pickup, because we don't want to just put more and more gas power stations going forward. We want to have a range of supply. So I think particularly wind turbines. I think also battery farms. Solar farms will start to lead to actually more of this application. We're seeing quite a strong order book for Invinity. It's been supported by the National Infrastructure Fund or something similar to that. I think they put in 15 or 25 million in the recent fundraising, having done about 6 or 12 months due diligence. So again, yes, absolutely. We think that's just the kind of thing where you're just getting in, hopefully after the investments concluding, going to generate surplus cash going forward. As that surplus cash comes through, then hopefully the share price can rise considerably from here.
Yeah, I mean, battery farms, it's an absolute sort of no-brainer in my view. You could have local communities producing, whether it's solar or micro wind or water or what, energy, etc.
Absolutely.
And instead of having every house having its own battery, and there's one battery farm which serves a sort of like local community. And this one would be as good as any, no doubt about it. Okay, good. We've got another one from Nigel Batty Seams. He says, Gervais, have you ever had a look at Journeo, which I think is a hardware and software supplier into the transport sector? Specifically, it does sort of like, I think it did these clever sort of smart wing mirrors or just smart ticketing at places like Euston, and also sort of like, transport information systems. I don't know if you ever, the shares have done very well, actually.
Yeah, I mean, we have been a supporter of the company. They did a terrific acquisition about 18 months ago, which was, almost, I mean, the company they acquired, which was a retiring executive looking for a good home for his employees, really, was just a transformational acquisition. It was a wonderful deal for them. They raised capital. Fortunately, we were involved in that issue, and the share price has done well. They've announced a series of major contract wins since then. They've got a US contract with the New York subway as well. So, quite a lot to go for. The share price has done very well. To be fair, we don't think it's as lowly valued as many other companies in the small cap area. So, although I think actually the underlying, we think the underlying business that is continuing to be very successful, we've actually taken our profits on this one. And we've into other things, but what a good company, what a good acquisition, and what a strong order book they've got going forward.
Yeah. Okay, good. Well, we'll come on to the sort of the last one. We've got Concurrent Technology, which came out with a strong inline trading update this morning. I guess you like this one. It's basically, again, just sort of like ruggedized electronic devices which go into sort of bigger products, and they get design wins into, again, aerospace and industrial applications and defense and stuff like that, which is all pretty much topical, particularly on the defense sector. What's your sort of your latest on this one? Because I think things like Solid State have done really well. Judges Scientific, well, Major Solid State.
Yeah, I think it's interesting because I think this company is actually, it's probably more skewed towards the defense sector than the other two you just mentioned. But specifically, there's been quite a major change actually in the defense sector, where when you upgrade your tank or you upgrade your aircraft or whatever, you now actually just take out cards and put in new cards. So you don't need as many cases, because a lot of them used to be much more specific. They used to have their own systems and all the rest of it. Now they've sort of standardized systems. And that's been a massive win for Concurrent, because now if they do have the best board, and they do happen to, be in an upgrade cycle in a certain platform, then it's not just they get the board, but then they get all the replacements thereafter as well. So what's been interesting about it, there may be no upgrade on the figures today, but they've had 3 major contract wins in June, including the largest contract win they've ever had, which was for $4.5 million of plug-in cards for a prime contractor. But most interestingly, when you look at it, the detail of it, this is a company which is still quite small. It's still only about 87 million. But that adds the lifetime volumes just on that card alone over the next 7 or 10 years of around, say, $40 million of business. So extraordinary. You've got visibility, you've got strength. It's already seen. The share price has already come up, as you can see. It was 60p or whatever less than a year ago, and now it's 107. It's, as I say, 87 million market cap, but its sales can really drive, could rise quite considerably. I think we're in that kind of cash generation phase. It's one of our largest holdings. Actually, we've got a very large percentage across our client base, of about 13%. So it's a very, the risk reward ratio, again, with defense spend obviously a priority at the moment. Very attractive. I think the management change, which came about 3 years ago, 2.5 years ago, Dr. Miles Adcock, I think he's done a really terrific job in this case, to be honest.
Yeah. Are there any areas that you're sort of steering clear about? I mean, it was obviously Burberry came out with another sort of like a shocking trading update this morning in sort of top end luxury, which seems to be struggling. And you've got sort of like some areas are getting a bit more competitive. Anything you're sort of like, trying to move away for or avoid?
Well, the nature of it really is we just don't know what the future might bring. There's a range of outcomes, of course, but interest rates have been so high for so long that we think they will have a suppression on demand. And it's not just Burberry and some of the luxury items. We think, a lot of the mainstream items are going to come under real pressure. We think that, savings rates are still quite low around the Western world. Specifically, many governments are trying to issue more bonds each year than they're national savings, and that relies on international investors continuing to support them. And if we do get this shortage of hard currency, then you could get currency crises coming up. So coming back to it, if you get a currency crisis, say in the UK, I don't think it's necessarily coming, but just by way of example, if sterling goes down, you import more inflation, and interest rates have to stay higher for longer, and you get a really recession and companies fall over. So coming back to it, that's a rather long way of saying we're very cautious about cyclicals. We're very reluctant to invest in many of the cyclical areas. We think global growth will be depressed. China's already slow. We think inflation, whilst it may be coming down, if there is any extra stimulus injected to try and offset any slowdown, we think we'll just get inflation straight back again. So I think we're going to be fluctuating between sort of inflationary, too hot or too cold, rather than previously, which was just right. So Goldilocks, a lot of people talk about the last 30 years as being Goldilocks. I think we've got the three bad bears coming now. What we really mean is it's always going to be too hot or too cold, i.e. deflation or too much inflation. And that's going to make it very unstable for companies which are funded principally by debt. Particularly, zombies, particularly some of the private businesses. So coming back to it, we think quoted companies actually have a commercial advantage. They don't go bust so quickly, but they can acquire these assets from the receiver, as I said, for £1. Viable businesses which were unviable because they had too much debt coming in and actually driving extra return into cash surplus. As I say, small caps, in my view, are going to be by far, one of the best areas investing. And specifically, I think the UK, because it's undervalued, because it's underperformed for 30 years, and small caps are undervalued relative to the UK majors with the recent OIC redemptions, I think the risk-reward ratio, as I say, is unusually attractive at the moment.
Yeah, and given that outlook, in terms of the sort of the M&A boom we've had, do you expect that to continue? And likewise, we've had a sort of like an undercurrent sort of delistings as well. Where do you see both the M&A and sort of delistings going under the backdrop, the sort of more volatile inflationary backdrop that you see?
Yes, I mean, as I mentioned, a lot of the companies we've been through today, their valuations are too low in our view, and therefore, when you look at the board and they say, well, is it really worth remaining listed? And a lot of companies say, not sure. So we have seen a lot of delistings. I think we'll see further delistings. My view is actually it's probably the best time in terms of the future potential for listings that I've seen for several years. So coming back to it, I think it's exactly the wrong time to delist. That won't stop some companies delisting. It won't stop some companies selling themselves for 50 or 100% upside. Sounds great in the short term, but actually, many of these companies, as we've seen, when they come right, they don't just go up 30 or 50%. They can double or triple and all that kind of stuff. So we're very reluctant to see our companies being taken over at the moment. We're very keen that they remain listed. Specifically, when they come right, share prices can move so much more than people think. And it's that feature which I think sometimes, you look at the share price, it's gone down from sort of £1 to 60p to 30p. And they say, is it ever going to go back up again? Well, yes, it is. And sometimes it won't just go back up to 60p or even £1. It can go, with a decent acquisition from the receiver to a considerably higher level in due course. So we think people are really overlooking the scale, this option value type of upsides of some companies. Most companies won't achieve it, but some will. And a few achieving it make all the difference.
Yeah, no, I need to find a few of those. In terms of just finally, in terms of the IPO market, we've had a couple of interesting ones. We had Rosebank Industries last week, which came at a massive premium after sort of 2 days. And then we've also had Raspberry Pi as well, which has done rather well. Are you seeing a sort of better pipeline for IPOs coming through to the fund managers to potentially have a look at, or is it still pretty depressed?
Yeah, I mean, there's always a good number of companies thinking about listing in the market. I suppose what I've been disappointed by is by some of the past IPOs which have done so badly. I won't go through them all, but several of them have gone down 75%. Some have gone down 90% over the last 5 years. These are often medium-sized or larger companies. Companies coming at 3-5 billion market cap. Extraordinary that they've come at those kind of valuations. So anyway, I think we've got to be very careful about the companies we do allow to come to market. We don't allow necessarily some of those companies with downsides, risks in them, which have come to market. But coming back to it, absolutely, I think Raspberry Pi is an outstanding business. They could have listed in the US. They chose to list in the UK. I think that's a very interesting business, but more importantly, it just shows what can get away. As you say, we've had the Rosebank, we've had others as well. Helix this year, which has doubled. Only a 10 million market cap, but so actually, I think the market's alive. We're doing just fine. I think the outflows have been less. The takeovers have meant that actually small cap fund managers, particularly professional managers, private investors have got some cash to put into companies now. So we are seeing some of the placings being quite well subscribed, actually, sometimes oversubscribed, secondary placings, not just the new IPOs. And so I think the market's in better balance at the moment. As I say, we still haven't seen that breakout in small caps. We saw that pickup last week. Is it the start of a new trend? I'd love it to be. I can't say it is. We'll know afterwards. But most particularly, that's the kind of indications which suggest that the sort of mega cap trend is running out of steam, and there may be a change of pattern coming up. And if there is, it's going to be big. It's going to last a long time. And small caps, in my view, are going to be one of the prime beneficiaries.
Well, that's a great place to end it then, Gervais. Just want to say thanks from the questions. Steve says thanks for your Invinity comments as well, Gervais. So that's great. But been really good, insightful comments, and look forward in touching base in about 6 months' time. So thanks very much, Gervais.
Well, thanks for your support, Paul. It's always a pleasure to chat. Thank you.